Hello, and welcome to the latest Expert Series webinar. Today's webinar is Ahead of the Curve, Short Duration Strategies to Enhance Yield. This is a complimentary Index Universe webinar courtesy of Guggenheim Partners. I'm Ollie Ludwig, the managing editor of Index Universe, and if you don't know us, we are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Bill Belden. He is managing director at Guggenheim Partners. In his role, Bill has direct oversight for exchange-traded funds and target beta mutual funds. Also joining us is Ann Walsh. She is a senior managing director and assistant chief investment officer for fixed income at Guggenheim Partners, and she's also head of the portfolio construction group, overseeing more than $100 billion in fixed income investments. Before we get started, I'd like everyone to know that you can ask questions at any time during the webinar in the window at the lower right of your screens. Also, the slides and the presentation will be available to all of you by early next week. So, notwithstanding the Federal Reserve's unexpected decision yesterday to continue its $85 billion a month bond buying program, bond investors would be remiss to stop thinking about how they plan to prepare for the end of the extraordinary period of monetary accommodation that has followed the market crash of 2008 and 2009. Whatever happens in the coming weeks, it seems totally reasonable not to expect a repeat of, say, 2011, when long-dated fixed income instruments were literally the best performing asset class in that year. To the contrary, the move in recent months among investors to shorten duration still seems very sensible. It also seems reasonable to surmise that the Bernanke Fed, first and foremost, yesterday sought to steer clear of what are likely to be difficult negotiations in Washington, D.C. surrounding the so-called debt ceiling. After all, what could be worse for the economy than rancorous talks in Washington and the start of what is sure to be an exceedingly delicate credit tightening cycle happening at exactly the same time? Translation: look to the Fed's policy meeting in December as the new potential start for the Fed's much ballyhooed tapering of quantitative easing. So if that's true, then today's guests have much wisdom to share. They'll be talking about the Guggenheim Enhanced Short Duration Bond Fund. This is an active strategy that enables investors to squeeze out a bit more yield on the short end of the yield curve. It trades under the symbol GSY on the New York Stock Exchange's ARCA platform. It has a little bit more than $470 million in assets, and for the record, it is cheaper than the leader in the segment, Mint from PIMCO. So, without further ado, I'd like to introduce Bill Belden of Guggenheim Partners. Bill?
Thank you, Ollie, and thanks to everyone for taking the time to join us for today's webinar. To start, I'd like to briefly profile Guggenheim Investments, and then I'll turn it over to Ann Walsh to take us through as what Ollie described as today's particularly dynamic market environment, and then against that backdrop, how Guggenheim is positioning portfolios to take advantage of opportunities that best align with our clients' needs in the short duration portion of the market. Along with insurance and insurance services and securities, Guggenheim Investments is one of three primary business lines for Guggenheim Partners. As a $151 billion asset manager, Guggenheim Investments offers a breadth of capabilities spanning fixed income, equity, and alternative investment strategies. Slide 5 reflects a chart representing the significant asset growth Guggenheim has achieved since 2002. A good part of the dramatic growth we have seen since 2009 reflects our increased focus on the financial advisor marketplace. With that as a background on Guggenheim Investments, I'm now pleased to turn it over to Ann to talk about the current market, and following her comments, we'll drill down into GSY, our Enhanced Short Duration Bond ETF. Ann?
Thank you very much, Bill. We're going to try to get the slides working here so everybody can see them. But basically, we're at a time in the marketplace where there's quite a bit of information about the economy and the markets generally, and there's a lot of indecision about what this means to make day-to-day investment choices by investors. One thing that we've seen is that, and we know about, is that the Fed has continued to expand the money supply in the U.S. To well over the levels that they saw, say, from the period, from really their inception almost, all the way till about 2008, when the Fed expanded the money supply precipitously. As you can see on the slide, it's at about $3.2 trillion right now is the base money supply. An interesting phenomenon has occurred, however, at the same time, and that is that the velocity of money has declined. The velocity of money effectively is the willingness of banks and other providers of capital to provide that capital into the marketplace and to lend that money. Why is this important? Historically, the feeling has been that when the Fed expanded the money supply, that inflation immediately followed. But we've seen that, in fact, that hasn't happened, although that's been the expectation of many investors over the last several years. So naturally, when the Fed started speaking this year about ending their easy money policies, the market really paid attention and reacted strongly. Well, why did they react strongly? On the next slide, you can see that historically, when Fed intervention ends, long-duration bonds perform very poorly. We've actually come through a period recently that's similar to one that existed after World War II and ended in 1951. During that period of time, the Fed managed interest rates and kept interest rates on the 10-year to below 2.25%. You can find out more about this particular time in history by going to the St. Louis Fed website and researching it. But what was critical was that at the end of that period of time, it introduced what became a 30-year time frame of a bear market in bonds. And you can see the impact, which didn't turn itself around until the beginning of the 1980s. During this period of time, of course, interest rates rose precipitously and inflation really took hold. So this is still in the minds of so many investors at this particular time, and they're looking towards a protection in their investment choices, particularly in fixed income. And while in our organization we don't necessarily see interest rates rising anytime soon, we do see it coming. As you can see, there's a Taylor rule, which is created by John Taylor at Stanford University, that targets or that estimates what the Fed funds target rate should be. And as you can see on this slide, the actual Fed funds rate is being held by the zero interest rate policy of the Fed, otherwise known as ZIRP, at between 0 and 0.25%. This zero interest rate policy stands in line and in face of what we believe to be our estimates suggested by the Taylor rule in the future of a rising rate environment. Obviously, what surprised everybody in the marketplace in the last 24 hours is the fact that the Fed decided not to end or reduce their quantitative easing program, that being purchases of treasuries and agency securities, but instead chose to hold pat with regard to the monetary easing. So, based on our estimates, we're still some time away again from rates rising, but the market is showing quite a bit of pressure to see and expects rates to rise in the not-too-distant future. What does this mean for investors? Well, if you're a long-duration holder of assets, as exhibited on the next page, you can see that we are in the era of return-free risk. If you take the example here on the page, which shows that at a coupon rate of 2.5% and a long-duration bond of nearly 9 years, that a simple 29 basis point move in rates up wipes away the total return that you would get by holding these 10-year treasuries. So you can see that you've gone from offering risk-free returns to actually becoming return-free risk. And this, of course, just as an example, is for treasuries, and it's purely based on interest rates. But this world works for any kind of long-duration asset. So there's risk out there for investors. Now, as I mentioned, while we perceive that this is not immediate risk, we do know that it's coming. As we've seen, history suggests that this Fed intervention ending does precipitate a very significant poor returns for long-duration assets in performance. The good news, however, is that particularly following these periods of monetary accommodation, historically, corporate credit and other types of fixed income assets enjoy periods of time of low default rates, therefore low what we might refer to as credit risk. And so as a result, we do believe that is a very reasonable time to be invested in what we call the spread sectors. Not necessarily long-duration spread sectors, but generally speaking, those that will benefit from the monetary accommodations that has come before. And as you can see on the next page, we still have yields at historical lows, and the spreads are above historical levels. So what does that mean? Well, while we're at low levels of yield, we still have the opportunity for more spread tightening. So again, the spread sectors offer a beneficial investment choice for investors. So what's the challenge? The challenge is to find yield in a low-rate environment before we see rates starting to rise again, and yet to protect investors against what really is a duration risk trade in the marketplace. Now, a lot of investors have already invested or embraced the idea of cash as an investment. Approximately $2.6 trillion is invested in money market mutual fund assets today, and about $5.5 trillion in bank deposits. So while cash is important, maybe investors have gone a little bit overboard in this in a rush to avoid risk at any time or any cost. So we believe that there's another additional technique that could add, or a strategy that could add value to a portfolio. So that's what we call short duration. So that's a strategy with a duration of less than 1 year, which does seek to maximize on these trends towards low default rates, but available spread tightening in parts of the fixed income market away from treasuries. And so gaining attractive income while keeping duration relatively short. It might be useful to note that in this particular time, because of the market the way it is, you see a very, very steep yield curve in the short end of the marketplace. So even a small extension in duration can pay off for investors with an opportunity to enhance their yield. Turning towards some strategies that might be useful for investors, we turn to a slide that represents how difficult it is to meet these challenges for investors. A couple of things that are very noteworthy in the marketplace. First, the expiration of the FDIC insurance on basically bank accounts over $250,000 is forcing depositors to have to act suboptimally by spreading cash across multiple accounts in banks to preserve their capital. And the regulatory environment has introduced a concept of the floating net asset value element to money market funds, which we think will prompt investors to seek alternative investments away from the money market account. So there's a number of regulatory changes that are happening in the marketplace that, again, lead us to conclude that there are better ways to invest short duration assets or cash alternatives. What we see on the next slide is really the balance between cash portfolios, which basically have protection against rising rates, but they have a very low level of income. And especially since yields are still going to remain stubbornly low as long as we're in the zero interest rate program, or the ZIRP, that's been put forth by the Fed. They've stated that they don't intend to release ZIRP until probably 2015 or maybe even 2016, notwithstanding what they may do to taper or eliminate quantitative easing on the long end. So unfortunately, short duration investors are still going to suffer potentially with little opportunity for yield. So the challenge there is to look beyond money market funds, but still maintain liquidity. We've already talked about longer duration assets and how a rise in interest rates is significantly damaging to portfolios with the long duration. So we believe that the solution set to this challenge, or this balance between these challenges, is a strategically constructed short duration portfolio which offers enhanced yield, relative value because of the types of securities that are held in the portfolio, and opportunity to gain some yield because of the construction of the portfolio. Now let's discuss some different aspects with regard to short duration. There are really kind of three strategies, or elements, if you will, to short duration asset management. They include cash, what we refer to as ultra short duration, and short duration. Sometimes you might have heard of these as cash, enhanced cash, and extended cash as other ways to describe these particular types of investment strategies. Cash, pretty obvious. Individual securities or money market funds that are held, treasuries, T-bills, I should say, very high quality. CDs is an example, very highly liquid. Average duration is very short, maybe a quarter of a year or less. And they're usually, as I said, thought of in terms of T-bills or money market securities or money market funds. Sort of an interim step is the ultra-short duration, which you get into an actively managed portfolio, which is investment-grade quality, and it uses all the potential sectors in the marketplace for fixed income. And you might use a potential benchmark there as a LIBOR or T-bill based, but you're then talking about a duration of the assets of less than 1 year, but not as short as the cash portfolio. And then finally, a short duration portfolio might be, as I said, called extended cash, is an emphasis on total return with a much longer duration, extended beyond 1 year, usually in the 1 to 3 year category. Each one of these particular portfolio strategies takes advantage of the fact that the yield curve, as I mentioned, the yield curve is steep, and so the little bit longer duration and the more diversification of the individual portfolio holdings begins to add yield and return opportunity for investors. What are some real key value added elements to putting together such a portfolio? Well, they're described on this page 18 as the areas that we focus on. Liquidity. Obviously, if an investor is invested in cash or short duration assets, they're highly concerned with liquidity, and they want their portfolio to perform as close to NAV or par as it possibly can. These assets can include treasuries, of course, T-bills, commercial paper, actively priced corporate bonds, securitized assets, repo transactions. Another category that's critical for the management of these types of portfolios is duration. And you can get duration short in several ways. Obviously, you can buy a very short maturity asset, like a T-bill or commercial paper. Other alternatives include repurchase transactions or repos. Otherwise, there's another way to do that, and it's to use floating rate securities, including bank loans or structured securities assets that have floating rate components, again, minimizing interest rate risk to any kind of portfolio. And then finally, to add a little bit of duration in order to take advantage of that steep yield curve, focus on high-quality corporate bonds or other types of related securities that have short maturities but that can add yield both on a spread basis as well as a duration basis. Again, with the goal to properly bucket into any one of the categories we've already mentioned either in the ultra short duration or the short duration buckets. There are several ways to gain yield in a portfolio. Most Conventional wisdom believes that the only ways to do that are to either decrease credit quality or to increase duration. And certainly at the short end, as I've just mentioned, duration is a critical area by which you can increase yield in a steep yield curve environment. But another area is to add diversification or other types of assets. Not necessarily to go down in credit quality, but to add assets that aren't necessarily available to individual investors, but could be available to investment managers such as Guggenheim. These include asset-backed securities, which we've already mentioned, and one of the things that we like to look at is how these particular types of securities perform in relation to others. For example, structured securities and corporate bonds have a mitigating effect on each other because they're non-correlated to each other in different types of market conditions. And so that's one way to gain risk management and to mitigate risk in the portfolio through diversification. We believe that by building a portfolio where you limit concentration risk, individual holdings, to a very low percentage of the portfolio, and you balance the portfolio by diversifying not just across issuer name, but across the asset type and maturities, that you build a portfolio that over the course of time will be risk mitigated and will perform better. Finally, in terms of the rating, quality of the portfolio is very important for a short duration portfolio. Again, with the emphasis on liquidity and availability of cash, quite clearly a high quality portfolio is important to investors. Having said that, we believe that with the proper amount of due diligence on individual securities, that investors can gain additional yield in the portfolio by selectively taking credit risk on those assets that have undergone a rigorous credit review process and evaluation. We talk about this as taking compensated risk. Predominantly, the portfolios for short duration should be investment grade, but taking compensated risk does make a lot of sense for gaining that additional yield in the portfolio. At Guggenheim, in terms of our philosophy, we tend to believe a few things, and these are very important in assembling a multi-credit short-duration portfolio. The first is that fixed income markets are inefficient. I think that probably the most critical aspect of this is that there are a lot of assets, at least as regards the fixed income market, that are not commonly invested in by all parties. And companies like Guggenheim, who have a deep and rigorous research process and a relative value bias where we look for assets that not everybody gets to invest in, that are institutional-only investments that add value to a portfolio, that is one way to take advantage of the fact that fixed income markets are inefficient. That the fixed income investment universe is very broad, and investing in non-index securities can add a lot of value. Examples include asset-backed securities and repurchase agreements or repos. One of the most important and critical aspects to investment in fixed income is the fact that fixed income markets are inherently asymmetric. And what does this mean? It means that the risk of loss, as we know in fixed income, is a significant risk. And managers have to take a very careful view of the fact that they want to avoid default or loss, especially loss to NAV or to loss to principal for investors. And this is critical in the short duration asset management arena. In particular, again, this goes to liquidity and to aspects such as credit quality that we consider extremely important in managing a short duration portfolio. As I mentioned earlier, of course, the markets at this point in time, however, are favoring corporate credit, and default risk is low, and we expect it to stay very low for the foreseeable future, given the monetary accommodation that the Fed has engaged in. So we have a lot of positives in the marketplace, But at the same time, we're always mitigating risk and evaluating corporate credit and other spread sectors to engage and to ensure that the portfolios will perform. And we're engaged in this risk management at all levels of the portfolio management process. So now I'm going to turn this over to Bill Belden to talk with more specifics on the Guggenheim Enhanced Short Duration Bond ETF, GSY.
Great, thank you, Ann, and I think that provided a great perspective on the way in which Guggenheim approaches portfolio management and portfolio construction within the short duration area of the marketplace. To narrow that focus a little bit more, I'd like to talk specifically about the Enhanced Short Duration Bond ETF, ticker GSY. Now, as Ann discussed, if you were to kind of summarize some of the highlights of her comments, you would see that our approach to managing within this space emphasizes a couple of key factors. One, the flexibility that we have in seeking value. Number two, the discipline that we have in applying that process in portfolio construction. And number three, the deep bench and the rigorous process that Guggenheim possesses all can combine to deliver a solution, which is how we like to position GSY. So again, the flexibility that we have as far as the maturity and duration profile of the product, keeping that average duration of the portfolio less than 1 year. We do want to be defined within that particular space. We see a lot of value there, obviously. I believe the investors in GSY have been rewarded with that exposure and the returns that they've achieved to date. And the other elements that help contribute to that is maintaining that investment-grade portfolio, but doing so in a way that takes advantage of the flexibility that I mentioned a moment ago, which does include our ability to invest up to 10% in non-investment-grade securities and to seek out other return opportunities in area of the marketplace that many of our peers do not. Now, third, again, keep in mind that this is an active strategy, which is somewhat obviously rare within ETF land, but is an area of the marketplace where we really believe that an active approach to implementing portfolio management and construction really can add value. We are, as Ann and Ali before her described, in a very dynamic part of the market, particularly now with all the interest focused on not just what the Fed is doing, but what is happening globally. So we really feel like our ability to be nimble and operating within that space and the active approach that we take to executing on this strategy allows us to add value based upon our market views. And did talk about the depth of our bench and the rigor of our process in constructing the portfolios, and we believe that that is also a differentiating factor in terms of our ability to approach the short duration part of the market in a relatively unique way against other managers that are in the space. So each of those aspects of portfolio management combine into delivering a profile for GSY. You do see there on slide 21 some of the characteristics as of the end of August for GSY. We're offering an attractive 30-day SEC yield of 0.93%, very short, ultra-short duration profile at 0.2 years, and an average yield of maturity of 1.22%. So when Ann was talking about kind of that landscape for strategic cash within the marketplace and where investors who are increasingly challenged to find sources of income are looking for solutions, we believe that GSY offers a very attractive one. Slide 22 gives a little bit of the performance history at the bottom of the page for GSY. Again, we feel like in contrast to what is an increasingly crowded space, again, when GSY was first brought out, there were only one or two other competitors in the ultra-short space, but we're seeing sponsors get fairly active in terms of registering for some new products, and some of those have actually been launched to date. So obviously there's an abundance of activity there, and I think a lot of us see real opportunity there to add value in the face of, again, what is a very dynamic market environment, not just as it relates to that space of the duration curve or the credit spectrum, but also within the regulatory framework for what's happening with money market funds and what's going to be happening with money market funds, which we believe positions a product like GSY very well for continuing to meet more investor needs than even we have been able to date. A point of clarity on the performance history for GSY. We actually launched this product originally as a passive product back in February of 2008. So the performance history, prior to 2011 reflects that passive approach. We began employing the current active strategy utilized to manage GSY in June of 2011. So while the performance history is strong throughout, in particular, I'd focus on the more recent performance history in comparison to both our peers and the benchmark. On the bottom right of that page, the GSY allocation, I think, also is emblematic of what Ann talked about in terms of the diversification that we have available in the product from a security type, and that is an area of the market which, again, we're active in seeking to add value to the portfolio. Slide 23 is just a simple visual on how GSY has grown throughout its history, again, in particular with a focus on the implementation of the active strategy that we began delivering in June of 2011. And so we've seen a nice acceleration in growth here, again, with the current AUM in the fund at over $470 million. More people are starting to take note of what GSY has to offer. Having a good history behind us is very helpful in that regard, and our approach to implementing that strategy has been something that's resonated with investors as well. I think, again, when it comes to positioning GSY, we're seeking to strike the right balance. We believe that in the hands of advisors who are trying to meet the needs of their underlying clients, GSY is a solution for investors who are unhappy with what's available and what they've been using for strategic cash allocations, and or are seeking to reposition for what is ultimately going to be a rising interest rate environment. So, again, I think that we're very careful to make sure that the product is positioned appropriately. It is not a cash product. It is a cash alternative product. It is not a fixed NAV product. It is not an insured product. But it is a product that adds value for a level of risk that we feel investors should be comfortable with when seeking out strategic alternatives for their cash allocations. There is a research piece that we put out earlier this year that we call the core conundrum, and I think it really represents well our view on what the challenges are that fixed income investors in particular are facing. And there's a quote from the core conundrum that's there that I think captures, what is a very interesting framework for decision making around making choices for allocating products, or rather allocating investment portfolios along a duration curve, and yet achieving the investment goals that everyone still has in terms of the need to have access to portfolio yields to meet their income needs. And again, the fact that those are not mutually exclusive objectives and striking that right balance that I alluded to a moment ago is not an easy thing to do, but it's something that investors need to keep in mind. So to summarize, the benefits of GSY is the enhanced income potential against stagnant cash portfolios. Again, when seeking out alternatives for implementing strategic cash allocations, again, kind of whetting that need for what sort of incremental risk are you willing to take on in return for incremental yield opportunities, and we feel like GSY is very well positioned in that framework to add value for a marginally incremental level of risk relative to just a straight cash investment. Again, it positions well against the a rising interest rate environment. The pace and speed and timing of that rise has perhaps been called into question, but it is coming. So we think that the product, in the way that it's constructed right now, is well positioned in the face of that challenge. Again, the emphasis on active management, again, that's our core competency is active management within the fixed income space. It's something that Guggenheim excels at for the reasons that we talked about earlier. And frankly, the parameters of the investment strategy for what we're doing in the ultra-short duration space enables us to be flexible in how we go about in achieving the investment objective that GSY has. So that's something that we take full advantage of. And then lastly, establishing that balance between yield, credit risk, and duration risk is a challenge that, again, is something that we have a long history in. And we have very strong capabilities across our complex in delivering these types of solutions, and GSY is a great example of that. finally, the team behind the implementation of GSY is led by Scott Meinert, our Global Chief Investment Officer. Many of you are familiar with Scott. So Scott leads the investment team. Ann Walsh, who is obviously you've just heard from, as our Assistant CIO for fixed income, is instrumental in delivering the strategies. And Scott and Ann are supported by James Michael and Chris Dorr on portfolio management activities for GSY. Their bios are there, and they're in great detail. And again, you can see those when we deliver the presentation out to you. The obligatory risk disclosures at the end of the presentation. Catch them while you can, and again, you will get a copy of the presentation so you can make sure that you're fully versed in those as well. And with that, those were the end of our prepared comments, Ollie. If I could, I'd like to turn it back over to you to kick off a little Q&A.
Thank you, Bill, and thanks, Ann. Yeah, we definitely have time for some questions, and we have a few of them from the audience. So, again, if you need to ask a question, please enter it at the lower right of your screens. So I want to take a step back just for a moment and ask, I think either of you, probably this is a question for Ann. You had talked about the SEC regulations. Can you describe that? How you see that playing out? You had suggested that it's going to be advantageous to products like GSY. Can you speak to that a little bit? It's certainly not resolved. There's a regulation in place that sort of, to those who don't know, the breaking of the buck has been taken off the table partly, but it's also still there. It's a little complex. It hasn't been worked out yet. But situate where you see GSY in the context of where this regulatory discussion may end up.
Well, I think that as you say, the regulatory environment is not yet certain, and I think as a result, investors would do well to prepare themselves for the eventual change to this particular marketplace. And by that I mean that the potential elimination of the what has historically been the NAV protection, as we saw in the last crisis. The FDIC stepped in, other regulatory bodies stepped in to effectively guarantee mutual funds. I think they have determined that that is not feasible, and they want to change the regulation because they are preparing for whatever may be the quote-unquote next crisis, and not to be in a position at that particular time to bail out mutual funds in the money market space. So critically, I think that we will see changes to this particular environment in the future. So I think it is incumbent upon investors to be ready for those changes and to anticipate them. And one of the ways to do that is to think about how to position short duration cash portfolios going forward, and what preparatory steps they can take to find the right kinds of portfolios and the right kind of asset selection and choices in the marketplace, that while they might not have the regulatory protection of not breaking the buck, that will protect them from a high degree of NAV volatility, and to ensure that the portfolio that they were investing in and plan to invest in actually is the one that they get. And risk mitigation steps that portfolio managers take would be something that investors will want to know about, such as GSY, where we are concerned with regard to risk mitigation and the non-correlation effect of the individual investments and securities that are held in the portfolio. So I think that's probably the way I would think to look to the future, is to be prepared for whatever may come, but to ensure that investment choices are made in such a way that investors themselves feel comforted that they've made risk mitigating choices.
All right, thank you, Ann. I also wanted to ask, I alluded to the fact that GSY is priced a little more cheaply than the main competitor, Mint. And I wanted to ask this straight up. These are active portfolios, both of them, GSY and Mint. So if you're making a case to a potential client or to an advisor, how do you pitch your fund relative to something like Mint? I imagine this is a Bill question, no?
Yeah, I'll take that one, and we're obviously having quite a few of those conversations. I think obviously the material that we just went over, serves as the foundation of that argument and the way that we approach the management of an ultra-short duration portfolio, I think, does contrast us against a portfolio like Mint, which takes on, a different profile in many ways. For a good part of its history, Mint has carried a much longer duration profile than GSY has, certainly since we started implementing the active approach back in 2011. With that, it has, through the entirety of its life, during periods of time, had a little more volatility with its net asset value than what GSY has. So I think that in some ways it's a different product, right? So it's given a little bit of a different risk-return profile. Now, acknowledging that they've moved around quite a bit there, and we've actually been able to deliver incremental yield, notably incremental yield on in excess of where Mint has been, while continuing to keep our duration profile notably shorter than what Mint has been, and with that, still been able to achieve the relative NAV stability that we've held throughout with GSY. So I think, if you look at the reasons, why we've been able to deliver on that description, it and again goes back to what we talked about before, in the way in which we're actually seeking areas in the marketplace that not every other fixed income manager is seeking to deliver the types of returns that are available for an inclusion in an ultra-short duration type of exposure. And it's our capabilities to go into those areas of the market, which would include, asset-backed securities or senior loans, or even a little bit of high yield, that enables us to go out and seek those returns, and through a diversified approach and a lot of credit research on our side, deliver a portfolio construction that's been able to deliver what GSY does. And again, that is right now a higher yield and lower duration. And the basis point improvement on the expense ratio, certainly when you're dealing in this yield environment, every basis point counts, and so that's not something that we hesitate to point out as well, that GSY has an expense cap currently of 27 basis points and Mint's at 35. So that incremental 8 basis points actually means something over time, and again, we're front and center with talking about that as well.
Okay, thanks. I wanted to quickly, before we move into much more granular stuff, talk about the breaking buck issue. Obviously, this fund GSY, that's obviously not part of its characteristics. But can you speak to the risks that do exist? Certainly, they're not like they are way out on the yield curve on the far reaches of it. But can you speak to the credit quality of the portfolio? There are certainly some questions coming in about that from the audience, and I wanted you guys to address that. That's certainly an understandable concern in the post-crash environment still to this day.
Well, I think that we continue to maintain an investment grade average rating for GSY. We do maintain a high credit quality profile. We highlight that on our website, so you'll see the, and actually, if I could go back maybe to the slide, if I can find it. 22. Is that going to get me there? No. Hold on. I'll find the slide that profiles the credit quality of the portfolio. But to your kind of the beginning of your question, Elliot, as it relates to breaking the buck, obviously we spent a little bit of time just a moment ago talking about the changing regulatory framework for money market funds, and the fact that one of the key aspects of the SEC proposal highlights a floating and net asset value, which will I guess force or enable managers to let the NAVs of the money market fund float. Our NAV, if you look at the history of GSY, has been quite stable. It doesn't seek to stay at the $50 that we initially launched it at, and it's moved north of there by a few cents and moved south of there by a few cents over its history, but maintained a very tight range. So I think that when you're looking at the type of exposure that you have and the type of yield that you're getting, we're very comfortable with the type of NAV volatility that's associated with investing in the product. So I would encourage participants to take a look at the history of the NAV movement for GSY and contrast that against its return history, and I think that they would agree that when we talk about the NAV stability without, ensuring that it's going to stay at $1, that it would typically align with what we believe their expectations would be for an ultra-short duration type of portfolio. Again, this is an ETF. It's not a money market fund, so, there obviously are other factors in play as it relates to bid-ask spreads for the ETF, and when you buy it on the market, obviously, you have to take that into account. And so we have a best execution desk at Guggenheim Investments that can support and help in finding liquidity and making sure that execution capabilities are made available to investors seeking to invest in the ETF. We always advocate the use of limit orders when buying an ETF, just to ensure that execution takes place at a price level that's consistent with where the investor wants to get it. But, if we're comparing and contrasting ETFs against, a money market fund example, I think that those are important considerations to have. Again, we took you to slide 21 there, which shows the credit profile or the credit quality for GSY. And I think, again, you've got diversification there, but an average credit quality for the portfolio that remains investment grade. So hopefully that addresses that question.
There are a few questions coming in from the audience about leverage. Is there leverage used in this portfolio? And taking a slight step back, what does enhanced mean at the end of the day?
That's a good question as far as that term of enhanced. I mean, I think that enhanced, we view it as something that's fairly typical within the we'll call kind of the cash plus type of or ultra short duration type of the part of the marketplace. Actually, we added enhanced to the name of the product back a couple of years ago when we got some feedback from the market that they actually in ETF land didn't like the use of the term ultra in it. So we felt like to try to capture, what the product actually delivers, the use of that term enhanced was something that was appropriate for the strategy that we're in fact delivering. So again, that kind of is the underpinning of why we used enhanced on there.
And just to be clear, it has no leverage.
No leverage. Yeah, I was going to follow up. Yeah, right. Okay, fair enough. Now, go ahead, Ann.
Well, I was just going to say, the term enhanced, if you go back to page 17, which we talked about the three categories of cash and short duration management, which is cash, ultra short duration, and short duration. In some worlds, ultra short tends to mean levered, and in that case, we wanted to eliminate that confusion that this fund has no leverage, and that's why we use the other terms of art, if you will, which is cash, enhanced cash, and extended cash. And so that's how we determined that this would be called the Enhanced Short Duration Fund. So if you look at those three categories, it's just the other term of art for enhanced cash, which would be what is otherwise known as ultra short duration.
Okay, great. Thank you. Now, there are also some questions about the yield relative to the expense ratio. These are going to get increasingly granular, so be prepared. Some good questions coming here. Is there any amortization of the premium that will offset the SEC yield of 93 bips, that is? And if not, adding back fees could result in a yield of well over 1%. And where is the risk in this portfolio rather than general credit risk? There's a few questions embedded in that, but surrounding the SEC yield for starters.
Well, the SEC yield assumes the payment of all securities according to their terms, i.e. Principal and interest according to a schedule with a maturity. A portion of this portfolio being purchased is in the asset-backed sector of the marketplace, and it has an element to it that actually accelerates the receipt of those payments, and that's how you get this average yield to maturity that's actually higher than the SEC yield. So we actually believe the yield that's going to be returned to investors is higher than the SEC yield. And that's a calculation methodology. With regard to how we intend to manage to maintain the yield and to get the kinds of value that we anticipate and have been able to achieve so far, I turn back to page 19. That kind of shows that in terms of our ideas and how we generate those ideas, I think it's this page. Is that a different page? Security selection factors. there it is, sorry, page 18, we really look to the categories. We want to manage around the categories of risk to enhance the returns, managing liquidity and the duration of the portfolio, but critically diversification. I really can't overemphasize this element of our process where we really are selecting individual securities and over-diversifying the portfolio relative to our peers in the asset management industry. Earlier the question that came up also with regard to risk and risk mitigation in terms of breaking the buck, one of the aspects of that is to not overexpose the portfolio. And when the buck was broken on the one particular fund, where the poster child of that, it was because they had exposed their portfolio to substantial holdings in one particular issue or issuer. And that is not what we're going to do. So we believe that by mitigating risk, that by using the tools that are available to us, including managing the duration, liquidity, and things that I've already talked about, are really keys to ensuring the portfolio performance going forward and the maintenance of the dividend yield for investors.
Okay, thanks. Now, there are also, forget about the comparison of Mint to GSY. There are a lot of other questions trying to compare GSY to other securities as either or propositions or something to accompany fixed income allocation with it. So I'll start with the following. There are a few of these. Why would you choose GSY over like a floating rate fund? BKLN has been mentioned as one. That's the very successful, the first to market one. Any thoughts there that you could offer to illuminate that comparative analysis?
Well, there is the element of floating rate, I'll give you, but you are talking about a longer spread duration in those portfolios. So to tell you the truth, even though you've got interest rate protection, you do have a longer weighted average life, they might be more comparable to a category of extended cash or, the intermediate bond category in terms of the actual expectation of cash flows and maturities, rather than a weighted, because the shorter weighted average life in a enhanced cash portfolio means that the individual securities will actually be maturing on a much shorter time frame than a floating rate fund would expect to have that happen. So you really do have less spread duration or credit risk, if you will, in a shorter duration fund such as GSY versus a floating rate fund or bank loan fund.
I would also just add to that. I would also add to that, Ollie, that keep in mind the BKLN is a passive product. It tracks the performance of an index. It's obligated to stay in that bank loan space. One of the things we talked about was the flexibility that we have in implementing the GSY strategy. So obviously in that very dynamic market, we have an opportunity to go elsewhere. So I don't think that point should be lost upon people comparing the two.
Well, let me ask you another question really quick about what you just mentioned, Bill. As the credit landscape changes here in the near and perhaps more distant future, how does that affect the holdings of GSY?
Well, in terms of when markets change, obviously we're going to make adjustments in the portfolio in terms of the relative value choices that are available to us. But we're going to continue to find where that value is. One thing, by the way, I should note, also just to finalize the answer to the previous question with regard to floating rate, and it's also relevant for this question as well, is that generally speaking, bank loans are not investment grade, and this portfolio focuses on being investment grade, and so there's a big difference in credit quality. We will continue to manage this portfolio to investment grade. We're limited on how much high yield we can own in the portfolio. And so as a result, we're going to continue to manage this portfolio going forward, with that maximum amount of 10% in non-investment grade under the prospectus. But we're also going to look to keep the portfolio more liquid. Again, we're going to stay within the guidance and the design of the portfolio and the product, which is, to keep it to under 1 year duration and continue to look for value creation in spread sectors. If, for example, we find that spreads have tightened, or that the risk in the markets has increased, we'll reduce the risk in the portfolio and hold more high quality or liquid assets and maybe even shorter maturity assets than is in there currently. if we see it's an opportunity to find value in other sectors, we'll rotate into those sectors. But again, all within the guidance of the prospectus and the limitations that we have for this particular enhanced cash portfolio.
Okay, thanks. Now, there's one question pretty specific about an allocation combo here. Does Guggenheim offer a laddered zero coupon bond strategy, and would that strategy be a good mix with GSY?
We don't currently offer within the certainly within the ETF or mutual fund or UIT or closed-end fund framework that type of allocation strategy at this point. It's something that we've talked about a little bit, but currently we don't have an offering available there.
Okay, fair enough. Now, this question is related to what I brought up at the outset with regards to the regulatory environment. And as you take measure of who's interested in this product, GSY, is it more on the cash equivalent, just a temporary resting place for cash, or is it more, as far as you can tell, being used as a fixed income allocation supplement?
I think it's being used more as the latter, a fixed income additional element in the toolkit, if you will, for fixed income investors that don't want to go all the way to earning, 3 basis points or 4 basis points in extremely short duration money markets or CDs or what have you. And they're looking for additional yield. They're looking to gain and target a part of their fixed income portfolio that they currently don't access. And they just feel that the yield that's achievable in money markets is too low. And they're actually looking for this more strategically than necessarily using it as a tactical play. Tactical play is better, I think, probably handled in that money market environment. But I think this is where people are going to put their money because they're worried about the fact that rates might rise in the next couple of years. They're concerned about that. They don't want the price underperformance of a long-duration portfolio, but they don't want to lose the investment income entirely. And so they're actually looking for this to be a strategic play as they believe that rates will rise. But they're not looking to tactically move portfolio allocations around with this particular product. Again, I think money markets make a better solution for that.
Yeah, I would reinforce kind of Ann's comments. We talk about this as being appropriate for strategic cash allocations as opposed to something you need to write checks off of. So, to her point, I mean, when constructing portfolios and seeking either tactically to take on a cash position for a period of time, but more importantly to maintain a constant exposure to cash, we feel like GSY is well positioned and structured to do that.
Okay, we have time for one more question. This could be a pretty quick one. If for any reason this fund had to switch to cash in some kind of a dislocation environment, how long would that take?
Well, we have this portfolio situated in such a way that it takes less than 7 days to liquidate everything in the portfolio, and much of it could be done within 1 day, and that's by design.
And I would add to that too, Ali, as you know, in the ETF structure, one of the beneficial aspects of that vehicle is that we do have the opportunity with authorized participants to do redemptions in kind. So to the extent that we were to get redemption activity in there, we do have the ability to deliver securities out to the authorized participant. While the bulk of transaction activity we see in GSY, it happens in cash, we do have that ability, which would certainly help to the extent we needed it, should the need arise for us to start moving towards cash.
Okay, thank you. That about does it. We're out of time. So
hey, Ali, could I jump in? Could I just close with one thing on our side, which is an invitation to participants on today's webinar to call our ETF Knowledge Center if they have more questions on GSY. We have a staff of individuals who are well equipped to address any follow-up information needs or other information that you may want to seek on GSY. The phone number for the Guggenheim ETF Knowledge Center is 888-949-3837. Again, 888-949-3837. And that's 1-888-YETF, by the way. So I should have gotten that in earlier, but wanted to make sure that I included it before we ended.
All right. Well, that's all the time we have for our webinar today. Bill and Ann, I want to thank you for being my guests, and I want to thank the audience for some good questions. Again, this presentation will be available to all of you early next week, and you'll receive instructions on how to obtain it in an email. On that note, on behalf of Ann and Bill, my guests from Guggenheim, as well as my colleagues here at Index Universe, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.